R Squared is our proprietary and turnkey premium financing program. So let's go right into it. Here we go. All right. So challenges with saving for retirement. Really, we've identified three major challenges that people face. Number one is taxes. Number two, it's market volatility and interest rates. And number three is contributions. So first one, taxes. Are they going up or are they going down? Most people believe that taxes are going to go up. I mean, take a look at the national debt. It's probably closer to 30 million or 30 trillion today. Last I checked, it was 29 trillion. We did this a couple months ago, or I put this in here a couple months ago, but tax rates are also at historic lows. So you've got the combination of high debt and low tax rates. So where do people think taxes are going to be in the future? Are they going to go higher? Most people would say they will. What I like to include, or what I like to talk about also, is this example that includes the highest marginal tax rate. So if you take a look at where taxes have been in the past, taxes have been much higher in the past. I mean, in fact, we're in a pretty low tax environment right now. So if you take into consideration the highest marginal tax rates at one point was in excess of 90%. I mean, that's pretty darn high. Right now, we're in a pretty low tax environment. That's going to last, I think, unless they make a big changes, till 2025, I think it is. Someone will probably chime them up and correct me, but I believe it's 2025. So we've got a little bit of time, and everybody's really benefited from these tax cuts that happened in the Tax Cuts and Jobs Act of 2017, I believe. Another big concern or risk that most people face is market volatility. Because of market volatility, if you take out money for retirement income, when the market goes down, it's really hard to make up for that, because you're pulling it out at a low point when it's likely to go back up. So this is a pretty good example. I mean, this is probably an extreme example, but this is the S&P 500 over basically 2019 to the middle of 2020, middle of 2019, middle of 2020. You can see, the S&P 500 went from, 3,400 all the way down to 2,400, and then all the way back up to 3,200 and by the end of July. And now it's at 4,600, 4,700. So markets have been extremely volatile, and right now it's benefiting everybody. The government's putting a lot of money into it, but that can easily swing both ways. I mean, that volatility can cut either way. You're either there's a sort of market timing issue that a lot of people are facing. You combine that with the fact that they don't have a good fixed income bucket to put their money into. So this is just the history of these are, I think they're treasury notes, 10-year treasuries, but they might be longer than that. But regardless, the point is the same. It's hard to really believe this, but back in 2010, 2011, there was government bonds paying almost 4%. They got back up to a little bit above 3, but now we're well below 2. So really, there's nowhere for somebody to get a consistent and stable, reasonable return that's going to outpace inflation. We also saw what inflation was. When did they come out with that? Back in November, I guess it was. You're looking at quite high inflation numbers as compared to what's been historic. Does that continue? Maybe, maybe not. Finally, contributions. Most people, and there's some studies on this, but most people think about retirement too late. So, in order to save enough for retirement, they have to reduce their expenses, don't spend as much so they can save more for their own retirement, or they're just going to simply have to accept a lower standard of living in retirement. This was a study that we got from a organization, but I found it pretty interesting. So if you look at people in America older than 40, about 25% of those have no retirement savings at all. Less than 50% had less than 250,000, and only about 20% had over 500,000 saved. So think about, those 75% of workers over 40 have less than 250,000 of money saved for retirement. Only 20% has in excess of 500,000. So you're talking about a large swath of America, whether they're high income earners or not, have very little for retirement savings. So it's really kind of interesting. Another out of the same study of people 67 to 73, 71% wish they would have saved sooner. 77% wish they would have saved more. I just found these really interesting and really pertinent to the R-squared strategy. So why life insurance? Life insurance, especially index universal life, which is what we're utilizing in this strategy, can really take care of two of those three things. First one is taxes. Life insurance is obviously tax advantage. If you've been writing life insurance, you probably understand this, but there's some really good benefits in that the growth on it is tax deferred. And if you take the money out via loans, it's tax free up to basis, and you can take out loans, or you can just take out loans for the whole thing. But income from loans off of a life insurance policy are tax free. In addition to that, the death benefit is tax free. In Texas, also, we have creditor protection, which is mentioned there. But when you compare the life insurance tax advantages as compared to mutual funds or a taxable investment account, annuities, which I've got it listed as tax deferred investments, or a qualified plan, what you'll find is really the only thing that it doesn't have is tax deductible contributions. You can't, there are some ways to do it, but then you lose some other tax benefits. But generally, life insurance does not have that feature to it. Now, like I said, you have the tax deferred growth of values, which some of these other options have. No IRS contribution limits, no 10% penalty if you take it out early. No RMDs at 72 and a half. 72 now. Distributions aren't taxable throughout lifetime, and so on and so forth. So there's some really major tax benefits to life insurance. In addition to that, I don't know if everybody knows this, but some people know about this. The tax code that deals with life insurance is known as 7702. I guess that's the section of the tax code, 7702. Specifically, I think it's 7702A, but that doesn't really matter to this discussion. What matters is back in one of the coronavirus bills, the CARES bill, it was the end of 2020. Somebody, I don't know who, a lot of people weren't even aware of this, but effective in 2021, they reduced the interest rate for the calculations on 7 pay tests, guideline single premium, guideline level premium, and oh my gosh, I forget what NSP stands for now, but essentially the MEC limits have increased. So how you calculate these MEC limits is an interest rate and guaranteed mortality rates. So if you remember back in, I want to say it was 2017, 2018, somewhere around there, they modified the CSO tables to be better than they were in the past. So MEC limits actually went down after they made that change. Well, the CSO tables have stayed the same, but the interest rate that they're using for that calculation has gone down. So it's allowed more premium to go in these policies. That was maybe a little bit too much of an education on this, but we can put more premium per the same death benefit into a life insurance policy, which, going back to this, really actually impacts the effectiveness of accumulation inside of an index policy. Second thing about index universal life policies is low volatility while still maintaining close to market performance. I mean, there's some indexes that are averaging 7 to 8%, but as compared to the S&P 500 or stocks, you're going to see much lower volatility. And compared to fixed income or bonds or whatever, you're going to see much higher returns. So this means your clients are not affected by the high volatility of the stock market and things like that. Put in a little bit of analysis because I guess I'm a numbers guy. I like this type of stuff. Maybe not everybody likes this type of stuff, but that's besides the point. What is the point is, if you take a look at 3 indexes, these indexes are from the policy that we're able to use in R squared. So it was pertinent. One of them is a NASDAQ. It's a NASDAQ 500 index with a floor of 0 and a cap of 9.5. We do this thing we call the best worst analysis. I find it interesting. It's a good way to look at things, but obviously, you can have some outliers. This is based on past performance, so it's not necessarily a guarantee. But the point of this is, over a 20-year period, the worst 20-year, if you go back to, I think it's 86 for the NASDAQ, the worst 20-year period happened to be a 5.5 return over that 20-year period. The middle, which could also be referred to as the median, and is actually really close to the average. In fact, I think it might actually be exactly the average, which tells us it's a normal distribution, or gives us a clue that there's a normal distribution. But the middle is 6.5, and then the highest 20-year period is 7.6. If I move on to another strategy, this is a volatility control index. The worst 20-year period is 6.6. The best is 7.7, almost 8%. And I meant the middle, or the average, is 7.7. And then the best is a little over 9.2. If I move on to an uncapped strategy with a spread, you've got a little bit wider of a chance for outcomes, but the worst is 4. I mean, that's not great, but the middle is 8 and the best is 11.5. So you've got some upside. We tend to recommend blending these indexes to give you a good average over a long period of time. So the point of all of this is you can have much higher returns with less risk with index universal life. Now, I'm going to show you some statistical analysis, and I think this means a lot to me. I'm not sure if it means a lot to everybody, but if you look at the S&P 500 overall average return, 8.35, 8.4, let's say. Standard deviation is 2.8. So 95% of the time it's going to be within 2 standard deviations. So let's call it 5.6 either way. So over a 20-year period, it's going to be 5.6 plus or minus 8.35, 95% of the time, plus or minus 2.8. 2 standard deviations. If you take a look at the NASDAQ 100, it's going to be based on history. The probability is that it's going to be within 1% of 6.5 over a 20-year period. So 5.5, 7.5. Mark 5, it's going to be 1.2 plus or minus 7.7. So that ends up being 6.5 to 9. And then the uncapped is about, let's say plus or minus 3.2. You're looking at a little bit below 5 to above 11. 95% of the time it's going to be between those. So the whole point of all of this is standard deviation on the S&P 500 is much higher. In fact, it's in some cases 5 times higher than these other strategies. So we can be reasonably assured that these are going to earn a relatively consistent rate of return. So that was kind of the long-winded way of saying indexing is more conservative than investing in the stock market, and you should expect less volatility, which means more consistent returns and less risk. So why financing? This really addresses the contribution problem or concerns that people who are saving for retirement face. So we can maximize contributions or the amount of money we're putting into this life insurance plan by going to a bank and borrowing more than what you're putting in to put into this policy. So, for example, the easiest example to make is buying a house or buying a piece of property that you're going to finance. If you put down $200,000 on a $1 million house, and the value of that house or property or whatever goes up by 20%, your value goes up to 1.2 million. If that's in the same year, your equity went from 200 to 400,000. That results in 100% return. Now, the danger of financing is if that same house goes down 20%, all of a sudden the house is worth 800,000. You owe 800,000 on it. Your equity goes to zero. So, in fact, this can't happen in R squared, but in other premium financing arrangements, you could actually lose more than what you put in. So that's just something to keep in mind when dealing with leverage. Leverage cuts both ways. So because of low interest rate environments, we can really just borrow funds for additional premium payments into life insurance policies. So what you're doing is you're really maximizing your contributions into this policy to increase your retirement income and increase your savings. So if you're able to earn more than the prevailing rate, which, as you've seen, the interest rates are very low. So let's just say your interest rate is 3% and you're earning 6 or 7% in the policy. You've got a spread of 3 to 4% on that policy. So R squared. To talk about R squared, I think first we need to talk a little bit about traditional financing arrangements. So typically, a traditional premium financing arrangement requires a high net worth. You have to have at least 5 million of net worth. That's not unattainable, but that probably cuts out a lot of people who are making, 300,000-400,000, haven't really done a good job saving, are really good at spending, and just haven't saved enough. In addition to that, you generally have to have a fairly large loan size per year. So typically it's going to be somewhere around 250,000. So you have to borrow a lot of money. Now, if you're borrowing that amount of money, that means you either have to make large contributions yourself, or you have to put up collateral. So that's the third point is typically a traditional premium financing arrangement requires some sort of collateral from the client. And that's because the surrender values inside the policy may or may not be high enough to pay off that loan. So it's not fully collateralized for the policy. So banks will require some sort of deposit at their bank, or maybe a CD or a letter of credit. And then finally, a downside to traditional financing is it counts against your credit personally, but also it typically requires a personal guarantee from the client. So it induces quite a bit more risk than, it's a ton more risk than buying a life insurance policy outright. And it's actually more risk than our R squared plan. So this is where R squared comes in. So R squared, we utilize a trust structure where we have a master trust and subtrust for each client. So what this allows us to do is pool loans together and borrow money at a much larger scale. So we're getting some economies of scale. So we're able to provide clients a lower loan amount and also a lower interest rate amount without them having to go out and borrow a fairly high amount of premium, dollars for premium. In addition to that, we have a no collateral requirement. So the policy fully collateralizes the loans against it. In addition to that, it's just simply a one-to-one financing. So the client puts up, let's say 100,000, the bank puts up 100,000. So it's not terribly it's not aggressively leveraged, but we typically see a 30 to 40% increase in income by doing this because of the leverage. I mean, you're getting a little bit of a additional boost from that. And finally, our R squared company monitors and administers the plan. So R squared handles all of that and handles the loans, handles the low point letters for the lenders, and really pulls these all together to make it simple. So how does it work? How does R squared work? So this example is a 45-year-old doing 50,000. The standard plan for R squared is a 10-year pay in. The bank is paid off in the 11th year. So client puts up 50 grand for 10 years. Beginning in year 2, the bank comes in. The first year loan in this case is 53,333. The bank puts that money in, and the client puts in the 50,000. Part of the 50,000 is actually serviced for the interest, and after the 11th year, the bank is repaid through a policy loan. And actually, the client is distributed from the trust structure. The ownership changes back to the client. So kind of a simple arrangement. What we do in our presentation is we compare doing the R squared to a qualified plan and a non-leveraged life insurance policy. So again, a non-leveraged life insurance policy with 50 grand of premium, the death benefit's about 800,000. With R squared, it's going to be 1.6 million. Total premium in the policy is 100,000 instead of 50,000. And then I have an example of a qualified plan as a comparison. In our presentation that we put together, we compare the life insurance to a qualified plan. We can actually change that out to an investment account if you wanted to. The qualified plan, a lot of people want to talk about that. And the reality of it is not very many people can get 50 grand into a qualified plan anyway. So that's one of those things that's pretty unlikely. But what we can show you is that qualified plan has an income of, let's call it 62,000. typical life insurance policy with no leverage, 69,000. And then because of the leverage in the R squared, we can get out 102,000. These are all from age 66 to 100. So the bottom line is the R squared can provide about 49% more income than a traditional life insurance policy. And in addition to that, it can provide 66% more income than a qualified plan. So this looks, this looks fantastic. I think. I mean, it looks great. I've got a, you might call this like a financing ledger here. This is just showing the details of everything. In the first year, the only contribution is the 50 grand from the client. In theory, the client could put up 100 grand if they had the extra money just to go ahead and pre-fund the policy. That'll just simply increase his income or her income. But you can see client payments is the third column on the left. You've got that 50 grand going in there. There's an administration fee, by the way, of $1,200 per year, which is included on this illustration. And then starting in year 2, I've got the bank loans of the 53,000. That goes up slightly every year. That's because we're taking more of the 50,000 to service the debt against the policy. So we're servicing the interest. And then, as you can tell, you've got the cumulative loan balance over here from, if you're looking from the right-hand side, the third column. I've got 568,000. And right here in the middle, the sort of grayed out box, I've got the payoff of the loan. So we pay off the loan, and then the policy is actually distributed from the trust arrangement, the R squared trust, and it continues on from there. They can take their income off of it or do whatever they want. So a question here is, can companies use a 162 bonus plan to deduct this? The answer is yes, you could do that. That would, however, have to be income to the owner of this plan. Something we do quite frequently is also a split dollar arrangement. So if it's a business owner, we might do a split dollar arrangement in addition to this. So that could be a solution as well. So, either you could do it either way. I would probably, unless you're doing it for an employee, you might be better off just paying for it. If you're a pass-through entity, you might be better off paying for it through profits from the company rather than taking that as income. Hope that answers your question, but that could be a solution to that. So we've done this at split dollar, we've done it through companies and whatnot. And it depends on if you're going to do this for an employee or for a business owner. So moving on from there, hold on, sorry. There we go. And then starting in year 21 or at age 66, I have income coming out of the 102,606, and that goes on till age 100. So R squared can really address, and if you have any questions on the ledger or how it works, type that in. I'll try to monitor that. It's kind of hard to see, but if I see anything, I'll answer the questions. Relatively simple arrangement. We're assuming a 6% rate of return in the illustration, a little bit below that, but basically 6% rate of return in the illustration. We're assuming a increasing interest rate starting at approximately 3% and going up. That's about what we're getting now. It's kind of floating around there. It goes a little bit lower than that sometimes. Depends on really prevailing rates. What we're going to get as far as the loan rate for the policy or the premiums. So that kind of depends. But uh, really R Square can address the three retirement issues, and that's taxes, market volatility, and low returns, and then finally contributions. And the contributions is addressed through the additional leverage that we're facing. So a few other notes on this. I'll be sending out a requirements sheet. So I don't know if I have it on this computer. Otherwise, I'd pull it up. But I'll do a quick overview of it. We're requiring a $25,000 contribution per participant. Ideally, it's 50,000. We found that 25,000 just works okay. The trust fee kind of eats up, some of the value. So, I mean, there's plans out there. I've seen some crazy stuff out there. So, you got to really be wary of what's being proposed. But 25,000 is a minimum. I like to see 50,000 ideally. You have to have an income of at least 300,000. If you have an income of 300,000, there's no net worth requirements. It's sort of blended down to 200,000. So like if you had a $200,000 income, you need a 5 million net worth. If you make 250, you only have to have about a 2.5 million of net worth. So it's sort of scaled. And in addition to that, we're doing a maximum age of 60 on this. Past 60, we found it doesn't really work very well. In addition to that, you have to have at least $1 million of face value. So basically, if you hit the $25,000 contribution and you're 50, that's going to be over the $1 million death benefit. So, those are the basic requirements for this and the basic things that people need to have. So I'm going to leave it at that. If you have any questions, my phone number is not listed on here. You can shoot me an email. You've probably all gotten emails from me. And so you can shoot me an email if you have any questions, and I'd be happy to answer them. And I'll be following up with everybody. So I'll be giving you guys a call within the next couple of days, or Brendan from my office will be giving you a call just to set up a follow-up if you have any additional questions. I just saw one question come in, and that does income mean gross or net? I mean, we're talking about AGI basically, and adjusted gross income, I think is the best way to put it. So that's what I'm going to look for. I mean, like I've had some where, all right, some guy's putting in 50,000 into a qualified plan, or he's had a lot of write-offs. We've been able to work around some of that stuff to understand where the income's going, but generally it needs to be AGI might be the best way to put it. If you're talking about like a W-2 employee, if somebody's got a W-2 income of 300,000 and I can prove that, that's pretty easy. I mean, I can run with that. But so anyways, hope that answers your question. I'll stick around maybe another minute or two and answer any questions that come up. But we're really excited about this plan. I think it's we're really excited about it. So I think it's a great plan. So anyways, if you have any questions, feel free to give me a call or shoot me an email back. And thanks everybody for attending today. And I will try to reach out to every one of you.